All right, so the next chapter that we're going to look at is deals with what's called cost volume profit analysis, and this is simply a way in accounting that we can say, okay, um, how many items do we need to make and sell? How many hours of service do we need to provide at a certain price um, that first allows us to not lose any money, and then secondly, allows us to make money? Okay, so we're going to get into a lot of terms, and I think that cost volume profit, if you will stick with it, is pretty intuitive. There's not a lot in this that is going to be really confusing, but I will say that um, there are quite a few moving parts. So with that said, let's go ahead and look at this a little bit closer. The first thing that we want to talk about um, is this idea of variable cost. And essentially what variable costs are, whether, particularly in a manufacturing environment, variable costs are costs that we will have that will increase as production increases. So if we're talking about direct labor, the more we produce, the more direct labor cost we will have. Um, the more we produce, the more direct materials costs we will have. In other words, if we have I think we looked at an example um, of broomsticks, and we said that we have different components in terms of materials. We have wood, straw, some wire, these types of things. Well, every time that we make another broomstick, each one of those costs goes up. So as production goes up, variable costs go up. As production goes down, variable costs also go down. So if we have a variable cost, we also have fixed costs, and these are costs that remain the same. Your textbook will probably give you the example of depreciation on the factory building, rent, if applicable. A supervisor's salary might be considered a fixed cost. Insurance on a building is a fixed cost. Now, that can change, and we're going to get into some exceptions on that. Let's see here, looking here, and then the other one that they give you here is property taxes. I do want you to notice that it says fixed cost per unit cost varies inversely with activity. What they're essentially saying here is that, let's say that we have fixed costs of $1,000, and we produce 1,000 units of product. Well, our fixed cost component is $1 per unit, $1,000 in cost, 1,000 units. However, because those costs are fixed to a point anyway, let's say that we make 2,000 units and our fixed costs are still only $1,000. Well, now our fixed cost component is 50 cents, right? 2,000 units divided into $1,000 in cost. So activity goes up, the fixed cost per unit goes down. And then finally, we have this concept of mixed costs. These are costs that have both a variable component and a fixed element. And the best example that I can give you of this, it would be utilities costs. So I want you to think about a large factory, and that factory requires electricity to operate. And their average bill each month for the electric that they use is $10,000. However, if they used absolutely no electricity, the bill might be, say, $1,000. So we have a $1,000 fixed cost component to the utilities bill. That is, we're going to charge you $1,000 just to have the electricity available, whether you use it or not. And then for every, say, kilowatt that you use above zero, it might cost 25 cents, whatever the case may be. And so we might have that out of that $10,000 utility bill, we might say that $9,000 of that is variable cost and $1,000 is a fixed cost. So we call these mixed costs because there's some of both, variable and fixed cost. Okay, so we have an example here, and you should probably spend some time with this slide. It's a pretty good slide. It's got some variable costs here, some fixed costs, and mixed costs, and then it's got lines showing examples of each one of these. Okay, and just as you would expect, direct materials, labor, and indirect materials are variable costs. Items like depreciation and rent are fixed costs, and then mixed costs would be utilities and maintenance. You say, well, wait a minute, what do you mean? What do you mean maintenance? Well, it kind of depends, because one of the things I don't see on here is indirect labor. And so if you think about a factory that has a lot of machinery and you've got some guys who are going to work, and you're going to pay you're going to pay so many hours whether they're doing anything or not, and then at certain times as they're working more, that cost can go up. So you have both a fixed cost and a variable cost component to maintenance and utilities costs. Now, we do need to also discuss, before we get too much into cost, volume, profit analysis, this concept of relevant range. Okay, and I want you to be kind of careful with what you read on this particular slide, because this is one of the few slides that can be somewhat confusing. But I want you to understand mostly about relevant range is that, I gave you the example earlier of the fixed cost of $1,000, and we made 1,000 units, and then if we made 2,000 units, fixed costs are $1,000. Well, I want you to think about this. If we were to continue to go from 1,000 to 2,000 to 10,000 to 25,000 units, at some point, even though most of the costs involved with the increase in production would be of a variable cost nature, we might have to open up a second facility. We might have to buy some additional machinery, these types of things. And so the depreciation cost that was fixed at, say, $6,000 a year now becomes $9,000 a year. So really, when you think about relevant range, the way I emphasize it is there's an emphasis on fixed costs. And basically that fixed costs will stay the same within a certain range of activity. Now, it does say here on your slide, whoops, let me go back to that real quick. It does say here on your slide that the relationship between variable costs and changes in activity level is often curvilinear. This is a pretty troubling comment, because variable costs generally have a set rate in which they go up. So when they're talking about this, if you know what curvilinear means, it just means that there's going to be a change, but the change is not necessarily going to be consistent. So just to kind of I'm kind of trying to help this slide make sense a little bit without confusing you. Think about a business that to do anything at all, we need 5 full-time employees. Our direct labor component might be very, very expensive, But then we can double our direct labor cost, but potentially increase production tenfold. Okay, so production in that case goes up, direct labor goes up as well, but it doesn't go 10 times up. In other words, we increase production tenfold. That doesn't mean that our direct labor goes up tenfold, if that makes any sense. And that's because we kind of needed to have that minimum of 5 individuals just to make a very, very small amount of products. So if you read the accounting literature on variable costs, curvilinear does not go with it. So just focus on the fact that fixed costs stay the same within a relevant range of production, and I think you'll be okay. All right, so we have a question on relevant range. It says the relevant range is the range of activity in which variable costs will be curvilinear. That is not the case. Variable costs are usually given a level of production, they are more linear in nature. They're only curvilinear when we look at extremes, extreme levels of production, particularly low levels of production. B, the range of activity in which fixed cost will be curvilinear. Well, fixed costs are nonlinear, and they have an inverse relationship to production levels. C says the range over which the company expects to operate during the year. This is going to be your correct answer here. And so what we're essentially saying with choice C, just to kind of clarify this again, is that fixed costs are fixed costs if we make, let's just say as an example, between 10,000 units and 28,000 units per year, right? If we produce fewer than 10,000 units, we might be able to get rid of some fixed cost. If we produce more than 28,000 units, some fixed costs come into play that we didn't have before. Okay, and again, there's your answer. So this video is already over 12 minutes. Let's go ahead and stop this one, and we'll pick up with the remainder of the slides next.